Frontline stocks and indices trade range, but midcaps see a strong rally. Realty and metals lead the charge, even as FMCG and capital goods drag.
Nazara Technologies is set to invest nearly 1,000 crores in pokerbazi owner Moonshine Technology for a near 48% stake, which could rise to majority share post-preference share conversion. Nazara is eyeing a fundraise to part finance this deal and is bullish on synergies from this big acquisition.
Gold shoots to an all-time high of over $2,560 an ounce, gaining over 22% in 2024. The yellow metal has delivered a heady 34% return over the past 12 months, and some analysts see it climbing further to nearly $3,000 an ounce in 2025.
August CPI inflation comes in at 3.65%, slightly above street expectations, and the CNBC-TV18 poll of 3.42. But bond yields have not risen due to crash in US yields. US yields fell due to source-based Wall Street Journal article indicating a possibility of a 50 basis points rate cut by the Fed on September 18th. Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Ekta Batra. As you can see at the top of our screens, the mid-cap index is doing extremely well today after a big rally that we saw in the last 90 minutes of trade on the frontline index. And that's exactly how trade has panned out so far. No problems with the frontline end of things. There is some consolidation as we move towards the weekend. But the broader markets, they are extremely well bid, with the advance decline firmly favoring advances right from the word go. When we started trade, we had about 1,400 stocks advancing and about 400 stocks declining. But now as we speak, those lines have come further apart, about 1,700 stocks which are in the green for about 650 stocks which are in the red as well. Everything doing extremely well, not just the broader markets, but even commodities. Brent has seen a bit of a spike from the lows of sub $70 per barrel that we saw a couple of days ago. And gold as well continues to shine, has moved higher. So the question is, where do we go from here from the frontline indices?
Hi, Banglam. Well, the surprises just keep getting thrown at us. We're so used to winning now that where do we go from here is probably even higher, is probably the obvious answer at this point in time, unless there's any kind of profit booking. Just want to point out that, yes, the frontline indices, however, are consolidating after that strong surge that we saw in yesterday's trading session in the second half. If you look at it on a week-to-date basis, the Nifty's gained around 2%. The Nifty mid-cap index, which is outperforming today as well, has outperformed on a week-to-date basis with a gain of around 2.6%. And the BSE small-cap index is up around 2% as well. But what stands out is the kind of gains that we've seen in specific indices. So, for example, the Nifty FMCG index is up around 3%. We have the Nifty Bank, which is up around 2.5%. IT index, which is up around 2.7%, and the Nifty Pharma index, which is up around 1.6% this week. So that's the kind of gains that we're seeing in specific sectors. And remember that many of them are sitting at record highs or close to those levels. So that's what's taking place in the market. Good advance decline ratio, and the mid-caps outperforming today. But let's talk about specific stocks. Samvardhan Motherson is under pressure on the back of a bearish brokerage note. Vinny is here with the details on that. Vinny.
Good afternoon, and yes, talking about Samvardhana Motherson, we're seeing the stock a bit under pressure. We have Investec that has actually downgraded the stock to a hold. Target price of 195 rupees per share. Now, main reason for this is the weakness that one is seeing in the European markets. That's the highlight coming in even in Investec's note. They're saying 36% of revenue of SAMIL actually comes in from the European side. So this could furthermore be a bit of a risk or a concern that comes in terms of future growth outlook for Samvardhana Motherson. Let's not forget, in the recent times, we did have BMW that cut its guidance as well, especially given in terms of the concerns that are there in the China market. Demand trends are quite slow there, as well as the European market. So that is the main reason, and that is why Investec has even cut the FY25, FY26 estimate by 3 to 5%. And the stock has outperformed on a YTD basis, 85% uptick versus the Nifty. It has been outperforming. So yes, that is a high valuation that we're seeing for Samvardhana Motherson, and that is why a potential risk that comes in, and we could see maybe a bit of a decline that one could watch out for in terms of the stock. Citi 2 is maintaining the sell rating for this one. They are saying a target price of 105 rupees for SAMIL, and 90-day negative catalyst watch is what they've opened up for Samvardhana Motherson. EU market decline and the growth potential there is a bit subdued. So that is also what Citi is highlighting. As well as one more thing that Citi highlights is that the company has approved raising of funds recently. Which mode is still left to be said and determined on that front. But if it's via debt, then that could be a bit of an impact that could come in terms of the balance sheet of the company. The net debt currently is standing at around 16,000 crores. So what is it going to be? That is the future outlook in terms of the growth prospect is a concern, and that is why SAMIL is under pressure today.
Take that point, Vinny. Thank you so much for that. Earlier outperformance, high valuations, and perhaps weakening outlook for the key customers is one of the reasons why Samardha Motherson was lower. But, these dips are being bought into. As we can see, the stock has recovered from the lows, currently sitting with a gain of 0.2%. The other one which is surging is DLF. In fact, the entire real estate pack is surging. CLSA has given a hold rating on the stock. Sunal joins us to tell us about the brokerage note and the reason why the real estate pack is a buzz in today's trading session.
Well, for DLF, the specific reason is there was a management meet, and that's the reason why the stock is in focus. CLSA, though, has a hold rating on the stock with a target price of 775 rupees a share. Now, management in its meet did say that they are targeting 15% sales growth and rental income growth over the medium term, and in their balance sheet, they expect further improvement. Their cash flows are set to improve, and so is their EBITDA. Now, remember, company has been seeing negative cash flows for a long time, and in last couple of quarters, that trend has improved. They expect it to improve, and that is something that the street seems to like. They remain positive on the NCR market, where we have been talking about a lot of exuberance, but they don't think so. They think there is a trend that they are seeing in terms of improvement, and that will continue as well. The capital allocation with the free cash flow that the company is now generating will be towards dividend. There will be capex and land buys as well that the company is looking at. So yes, they are looking at expanding, but not pan-India. They say that they do not plan to expand pan-India and will look at entering select new markets such as Noida and Mumbai. They've already started with Mumbai with a project in Andheri. It's an SRA project. But they are concerned about the rise of scale in which they are seeing operations among developers. Be it Prestige, we spoke to Puravankar a while back, Godrej Properties, they are looking at pan-India expansion, and that is something which DLF is worried about because they think this could lead to execution risk and it could impact the entire sector as well. So important commentary coming in from a real estate major when it comes to expansion that most of these real estate players are looking at.
Okay, well, more spoiled for choice, you'd have to say, Sonal. Thanks very much for that. So that's in the entire real estate space. Pan-India expansion is what real estate companies are looking at. DLF in focus, that stock up around 3% today. But the other space which is really buzzing is gold financiers. Muthoot Finance and Manappuram Finance are in focus. This is as gold prices have touched all-time highs. What does it do to these gold lenders? Abhishek is here to tell us more. Abhishek.
Well, gold finances are in focus given the fact that gold prices are at all-time high. In terms of the pricing, it's at $2,563 per ounce. If you take a look at the momentum with respect to gold prices, in last 1 week, it's up 2.5%. In last 1 month, it's up 7.5%. In last 3 months, it's up 18.5%. And over the year, that is year on year, it's up 33.5%. This augurs really well for gold finances like Muthoot Finance as well as Manappuram Finance. Muthoot Finance, remember, that has almost 99% of its business in terms of gold financing, while Manappuram has about 50-55% of the AUM in gold financing. So in Q1 FY25, we did see gold loan growth being very strong for these lenders on a sequential basis. Muthoot Finance, the gold AUM growth was 11% quarter on quarter at that time, and Manappuram as well, the gold AUM grew by 10% quarter on quarter. Just to alert our viewers, IIFL Finance has been absent from the market given the fact that RBI has put full stop with respect to the gold financing, and that also really augurs well for Manappuram as well as Muthoot with respect to their gold financing business. Back to you.
All right, Abhishek, thanks a lot for that. Gold financiers aren't the only ones which are benefiting from higher gold prices. If you just take a look at the jewelry stocks, and they've been a buzz for so many days. You look at Kalyan Jewellers. Yesterday, there was a positive brokerage note coming in. Today as well, there was a positive brokerage note coming in. Senco Gold is up. Even some of the lower rung jewelry stocks, case in point, something like a TBZ, which is up 18%. It's doubled in this year itself, more than doubled 1.5 times in this year. Moti Sons Jewellers is up around 6% as well. There are multiple reasons for these stocks to be gaining, and let's talk about each of them in particular. There have been positive brokerage notes on Kalyan Jewellers yesterday as well as today, and the street is increasing their growth outlook. Despite an 8x move that we've seen in Kalyan Jewellers stock price over the last 2 years, the street believes there is room for more growth, especially Titan's template is something that everyone's looking at in terms of them following. Secondly, for the entire pack, there is improved outlook for demand in the second half ahead of festive and wedding season as well. And then there is accelerated formalization in the gold segment due to duty reduction in the budget. So all these factors playing up for the jewelry space. In particular, for regional-only players, the likes of Senco, Motisans, etc., P.N. Gadgil Jewellers IPO is something that, the street is taking note of, and maybe some valuation rub-off taking place out there as well. And finally, higher gold prices. How do higher gold prices help gold companies? Typically, a lot of the lower rung companies have a larger proportion of their gold which is unhedged. So every time the gold prices rise, they do make some sort of inventory gains out there. The formal bigger players, the likes of Titan, have over 100% of their gold hedged. Senco has about 89-90% of their gold hedged as well. And Thangamayil too has about 89 to 90% of their gold hedged. So even if they have 89 to 90%, 10% of their unhedged inventory stands to benefit from increased gold prices. And for other players, one's sense is that it would be a lot more than just 10%, which would be unhedged. So as a result of which, higher gold prices would mean better inventory gains and better margins coming in for them. And that's exactly what the street is betting on, and explains why some of these names, especially the lower rung ones, are doing extremely well.
Okay, all right, Manglam. Thanks very much for that. So that's the entire gold financiers and jewelry space which is in focus in today's trading session. We need to take a short break, but we'll get you a rare and exclusive excerpts from our conversation with the management of Trent on their growth and expansion plans. Stay tuned. Welcome back. Well, you're still tuned into Halftime Report. Let's move on to a CNBC-TV18 exclusive. Trent plans to open 30 to 40 new West Side stores every year. In a rare conversation from the sidelines of the West Side Media Day with CNBC-TV18 Shilpa Ranipeta, the company's CEO and COO talk about expansion plans and demand trends ahead of the festive season. Listen in to this exclusive conversation.
The fact is, with the 200 plus stores that we have, at our current run rate, we get over 80 million walk-ins. So a significant proportion of it are actually young. Right. And so therefore, do we address that segment 100%? Do we address only that segment? Not really. Okay. So we are focused on them in a different way, in the way compared to some of the other brands. Right. And we want to be able to appeal to a headset and a mindset and not just an age group.
Are we looking at new categories or new sort of product ranges? Because you spoke about a lot of things that are new.
Everything has to be new. We're in fashion, and fashion's about newness. And for us, it's newness every Friday. Right. And so you've got to keep coming back to find it. Yes, we have a gifting collection. Yes, we have a new resort collection, fragrance collections, new footwear collections, new sneakers. I mean, I could go on forever. Right. So everything is new for the season. Right. Because we've got to stay fresh, we've got to stay relevant, and we've got to appeal to Gen Z, as you said. Indian people are holidaying. So we're playing into what's relevant. If they're holidaying, we're going to give them things to holiday. Right. If they're traveling, we'll give them a leisure collection. Right. I think for us, it's important to see what consumer trends are in India, and we satisfy that through our fashion offer.
Right, fair enough. And we'll talk about West Side also. Can you sort of give me a sense then, given the kind of consumer trends we're seeing, what can we expect from an expansion point of view? What do you have lined up for the year?
So we said in the shareholders meeting, we're thinking about between 30 and 40 stores every year. We've consistently maintained that we will do stores that stand up to a certain minimum standard. We're thinking of stores which are at least 20,000 square feet and more, iconic, and make a difference to each customer. Right. That she can relate to in a particular micro market. Right.
And how much of these do you see in a tier 2-3 markets? How big are those? Because we're seeing so much aspiration coming out of those markets, and retailers are now increasingly focusing on these smaller markets, given the aspiration there. What's your sense? What are you planning for West Side there?
In many ways, Westside does not only appeal to Tier 1 markets. It's as relevant today in Tier 2 and Tier 3 markets. It's a question of whether we find critical mass, Shilpa, in a particular market, whether we find the right location, whether we find the right building scheme and the economics work. If some of this come together, we're very happy, and actually very happy to be in multiple micro markets rather than in lesser number of micro markets.
Right. So that is an area that, I mean, Tier 2, 3 markets are something that you are looking at.
Indeed.
Right.
We already have several cities where we are present, towns which we are exploring. So it's something which is clearly on the radar, but it is not in exclusion of what we do in Tier 1.
Of course, fair enough. And what about online for Westside? You know, the Westside store also standalone. You do how much of a focus do you have on that end? And currently, can you give me a sense of how well is the online store doing for you for Westside overall?
Westside we've been reporting consistently that it's been contributing about 4 to 5% of our revenues on a quarterly basis. And online continues to be a very important channel to deliver convenience to our customers. Right. It is not about being transactional, so we are not really interested in discount promos, offers, coupons, that kind of push to sell. It is about convenience, and to that extent, to the customer who resonates with the Westside offer, all that Shailina talked about, we want to be able to say, listen, we are available online.
Right.
And in doing that, we again differentiated because we don't do any marketplaces. Again, a choice, matter of discipline. We do it only through westside.com or our app or on Tata Click. So we're just essentially listing on our own platforms.
But I would add to that as a brand, the aspiration of the online shop is as beautiful, is as considered, is as special as walking in a store. And the ease of shopping and the convenience. So we bring fashion to life with photography and with a vibe online. And I think we want to be an omni business where a customer can just transition from online to store and just resonate and connect with Westside at every level.
Is the Westside brand going to be the online amongst the universe of brands that you have under Trend?
Oh, absolutely. I guess Westside is going to be the brand which is going to be online. Right. And it is a choice that's for the brand that we made, and we will stay with it, Shilpa.
Fair enough. You spoke about the expansion of Westside also. Sort of brings me to the question, will you look at the overseas markets also for Westside eventually? Is that something that you would like to do for Westside?
We're very committed to India, Shilpa, at this moment in time. And India is a very interesting market and has a lot of growth opportunity. That said, I don't think so there is anything which stops us from exploring it in due course.
All right, a rare conversation with the management of Trent, where they are excited about Westside, the street is excited about Zudio, and overall everyone is excited about its entry into the Nifty on September 30th itself. Take a short break, come back on the market itself. We'll have Vinay Rajani join in with some trading strategy. Stay tuned. Welcome back. You're watching us here on Halftime Report. It's midday, perfect time to get you all the updates from the F&O space at midday itself. You just take a look at the markets, the frontline index, the Nifty consolidating a bit. The Nifty bank was splitting between red and green, now more green than red, 100 points on the higher side. What's important is after the big rally that we saw yesterday in the last 30 minutes, the dips have been pretty shallow and they've all been bought into as well. So we're just consolidating below the flat line, and that's a big positive. The other added positive is the broader markets. We have the mid-cap index doing extremely well. Typically that happens when the street believes that there is limited downside on the frontline indices itself. The advanced decline lines, absolutely parallel and pretty maintained when it comes to the distance between the green and the red lines, and this typically is a foreteller of what takes place in the second half of trade. If these lines start to come closer, then maybe we see some profit taking in the second half, and if they start to broaden, then maybe there is a bit of a melt up lined up for the second half today as well. To that, you also add the India VIX, and all these point towards a bit of an up move that we can expect in the last hour of trade today, because the India VIX too is coming down and has moved below that 13 mark itself. The Nifty levels to watch out for. The support has moved higher to 25,130, 25,150, the levels which were earlier resistances, which were broken out yesterday. And on the way up, 25,500 thereabouts could be the first leg of resistance. That's, something that we can see from the kind of call writing that we've seen at the 25,400 level itself. For the Nifty Bank, it is the 52,000 mark, where the Nifty Bank is just about 100 points away from that level. 52,000 call writers are pretty active, and a premium of close to around 222 rupees, telling you levels upwards of 52,200 may face some supply on the Nifty Bank. The one stock which I'm watching out for today is ABFRL. It may exit F&O ban after being in F&O ban for most of the September series. series so far. It's seen a bit of a recovery from the lows, and the open interest has come down, telling you that it's below or very near that market-wide position limit out of which it exits F&O band.
Okay, all right, Manglam. Thanks very much for that. So that's on the F&O space. We have Vinay Rajani of HDFC Securities who joins in on the show to discuss the technicals of the market now. Vinay, hi, welcome to the show. Well, what's your sense today? We had a strong rally yesterday. We seem to be ending the week on a stronger note as well.
Yeah, good morning and thanks for having me on the show. So yes, yesterday we witnessed a new all-time high which was at 5,433, and today is just a consolidation, and minor profit booking was there, but the overall trend remains positive. And the way yesterday's data came in derivative, we witnessed 10% long build up in the Nifty, and in Bank Nifty we witnessed short covering by 10%. So overall sentiment looks very good, and now the other sectors are also participating, like private sector banks have come in today. PSU banks started performing. Metal index since yesterday we have been witnessing some good buying coming in. So overall participation coming from the different sectors, and Nifty is into continuation of an uptrend. And I think overall dip should be accumulated for the higher targets. The resistance for the Nifty I see is around 25,525. Which happens to be the Fibonacci extension levels that we track on the Nifty, considering the recent swing high and lows. So 25,525 is the immediate target I see in the Nifty, and once that is taken out, then even 26,000 can be achievable. So overall trend is looking good, and Nifty has again caught up the momentum. And as we have been discussing, that 25,100, which happens to be the previous resistance, now it is likely to act as a support. So keeping that stop loss in mind, 25,100, one can continue to trade long, and every intraday dip should be bought into. The targets I'm looking for Nifty is around 25,525, followed by 26,000 in next couple of weeks. So yes, overall data as well as the technical setup is quite bullish, and intraday dip should be bought into, and for the positional targets of 26,000 even for next 2 to 3 weeks.
Okay, stocks?
Yeah, so I can see some strength coming into financial services stocks. So all housing finance stocks and NBFC stocks have been performing very well. So I'm bullish on Piramal Enterprise, which is an NBFC stock, and has today it has given a clear-cut breakout on the chart. So Piramal Enterprise, which is placed around 1115, can be traded long. For traders, I would suggest a stop loss of 1080. On the higher side, 1160 should be the targets if I were to take a 3 to 4 days view. So I'm bullish on Piramal Enterprise. The second stock I would go long is the TCS from the IT sector. So today IT index has hit an all-time high and looking into a continuation of an uptrend. So TCS around 4530 can be traded long. 4440 should be the stop loss for the traders. And on the upside, I'm expecting a target of 4700 in next 3 to 4 sessions. So these are the two picks, one from the NBFC space and another one is from the IT space.
Is there anything that you like from the metals pack?
Yeah, so the strongest stock and strongest setup I can see in the metal space is the Jindal Steel and Power, which we actually recommended to our clients in yesterday's session. So 1030 is the price of Jindal Steel, which can be traded long. Support I can see is around 1,000. So keeping a 3% stop loss, we can expect a 5 to 7% upside. So on the higher side, we can expect a target of 1090 to 1100 if I were to take a 1 week view. So with a stop loss of 1,000, Jindal Steel and Power can be traded long with a target of 1090.
All right, Vinay, thank you so much for joining in, giving us your views on the index and individual stocks. We take a short break. On the other side, we have Ankit Thakkar, who's the CEO of Jupiter Lifeline Hospitals, joins in to discuss the business outlook. And more importantly, the announcement that came in on Ayushman Bharat, where all citizens upwards of 70 would be included in the scheme.
Welcome back. Well, for the markets, we're just about consolidating at this point in time. In any case, I just want to point out that, there's one particular company we're going to be talking to, that's Jupiter Lifeline Hospitals. And we are talking to them about the Union Cabinet approving to cover senior citizens 70 years and above under Ayushman Bharat scheme. A few key highlights include that all senior citizens will now get around 5 lakh free in terms of health insurance under Ayushman Bharat. To assess the impact of this development on the hospital sector, we have with us Ankit Thakkar, who's the CEO of Jupiter Lifeline Hospitals, to talk about this as well as the business. Ankit, hi, welcome to the show. Well, I was just noticing it's been a year since you, I think, listed. You listed last year, September of 2023. And we're talking to you today about what has been a development in the Ayushman Bharat scheme. 70 years and plus will now be able to access and get insurance worth around 5 lakh rupees. How does it impact Jupiter? Are you empaneled?
So I think to begin with, it's a fantastic decision by the government. I think I'm very, very happy that this decision has been taken because it reflects on the kind of society we are and we aspire to be. A lot of senior citizens today are deprived of healthcare for financial reasons. They are unable to buy insurance policies at this age, and as a result of which they do not have access to good quality care. So this decision to cover everybody above 70, I think, is very welcome, and it's great for the country and the society. As far as Jupiter is concerned, no, currently we are not empaneled, and we haven't even seen the fine print of the regulations, etc. As they come up, we will evaluate them and see how they shape up.
So, but why are you not empaneled, Ankit, till now? Even for maybe a couple of specialities, why haven't you been empaneled till date?
So we have a few government schemes, but they account for just around 1% of our revenues and business. We have, most of our business coming from the insured segment, little bit out-of-pocket pay. And I think in the long term, what the government has said multiple times and now acted upon with this is that this really gives a fillip to cashless healthcare for all as a target. For above 70, it's Ayushman Bharat, where the government is a payer and the beneficiary is a common citizen above 70. But once a positive experience of this sort is felt by the community, I think it will even give a huge boost to insurance coverage for the under 70 population, which today just stands around 10% coverage on health insurance. So I think there's a huge potential there.
So you're not empaneled, and government services account for about 1% of your revenue. But, just generally, government or no government, what proportion of your patients who are, treated at the Jupiter Lifeline hospitals are above 70? And what are the typical revenues that you make from them, average revenue per occupied bed?
So, honestly, we don't really segment revenue in that way. So I don't have that answer ready with me today. But if you look at, the demography of the country, that would probably, it is just my guess, would reflect on our volumes as well, where it is a relatively young country where, 65% of the population is below 40. So above 70, I think could be, much higher than low single digits.
Okay. Well, Ankit, I just wanted to get a sense that what is the difference in terms of the average revenue per occupied bed for those that you are treating within government schemes and those that you are probably treated under Ayushman Bharat that you know of, and versus those who aren't?
So there would be a difference for sure. We only provide radiation therapy for cancer currently, and some surgeries for children born with congenital heart defects. So we have a very limited exposure there and experience there. So I'm not really clued into what the ARPOBs of the entire Ayushman Bharat scheme would be, but safe to assume significantly lower than private payers.
But how much? Like, is it a 10 to 15% difference in terms of ARPOBs? Is it maybe a 20% difference? The reason I'm asking is that, the Supreme Court at one end is probably considering a standardization, or, that's something which is on the cards in terms of standardization of rates being possibly a consideration. In that sense, how much do you think a company such as yours, which only gets 1% from government mandated schemes, will probably have to adjust their ARPOBs to adjust to these new standardized rates, or maybe, adjust to greater amount of money coming in from government schemes?
So I think India is a country of inclusions, right? Everything goes. I am a fan of filter coffee in on the streets of Matunga, and I also happen to frequent Starbucks. So both the things coexist very close to each other. That is India. So even in healthcare, I don't think that there is only going to be a one-size-fits-all approach in a country of this size and this diversity and this demography. You get what you pay for, you get what you want, and all segments will coexist. So in my assessment, I don't think it is going to really make huge differences on business models.
Right, that point is well made, that all things, all services exist at all different price points. The only risk is if Starbucks, by virtue of regulation, is asked to sell at the same price as a filter coffee. But that's a discussion for another day, another time. Thank you so much for joining in and giving us your outlook on the business itself.
Well, before, we just wrap up the conversation, just wanted to point out that I mentioned that it listed a year ago. And just look at the kind of stock performance that you've seen for Jupiter. It listed, its issue price was around 765 odd rupees. And look at the price today, it's 1361. So it's around 735. So it's an over 80% increase that you've seen in a hospital which is catering to the micro markets, which is probably the next leg of growth when it comes to hospitals. And you can see that reflect in the stock price at this point.
Well, we take that point. Nearly doubling from its issue price. Take a short break. In fact, on the other side, we'll focus on Thermax in our special segment, as always, Insight Edge. Welcome back. You're watching us here on Halftime Report. The Nifty Bank continues to do well, and as a result of which the Nifty is now cut its deficit from yesterday's close to just about 7 points. The Midcap index pretty above that 60,000 mark as well. So let's talk about some of the stocks that are buzzing around. Thermax is one of them. The company's strategically collaborated with Ceres Power for manufacturing of electrolyzers. Earlier today, we spoke with the management on this development. So let's talk about the special Insight Edge that Vamakshi has brought to us from the key takeaways from that management conversation.
Well, absolutely, Mangalam. This is a very big and positive development for Thermax, given that their earlier agreement with FFI had fallen through. And in fact, we had the management join us on the same, and they said that Thermax has specifically chosen SOEC, that is solid oxide electrolysis cell technology, making it the first company in India to do so. And that is because the SOEC tech is very well suited for steel, fertilizers, petrochem industries, which India seeks to decarbonize. They say that under this agreement, the core tech elements will be provided by Ceres Power, and this tech transfer is immediate. In return, they have to pay a royalty fee, and they say that this royalty fee will be quite reasonable in nature. The prototype will be developed in the next 1 year. It will take 2 years for the product to be available, and 3 years for them to actually fully scale up this whole unit. They seem quite unsure about how the space will evolve, and that is mainly on account of policy-related discussions. But the management anticipated that the market for electrolyzers in India will be anywhere between $2 to $5 billion, and they expect to capture nearly 10 to 20% of market share by 2030. As far as the overall performance is concerned, they say that they're quite optimistic on the performance in the rest of the year. Q1 did see an impact on the margins, but they say that is largely behind them. Overall, positive commentary coming in from the management on the back of this development.
Okay, all right, Vamakshi, thanks very much for that. In fact, let's listen in to Ashish Bhandari, who is the MD and CEO of the company, what he had to say about the electrolyzers market.
If you look at 2030, I suspect the market for electrolyzers in India will be a few $1 billion. Yeah, and in that, how big will SOEC be, what Thermax's share would be, remains to be seen. Even profitability will be driven by competitiveness, but I hope at least 10 to 20% market share should not be something we cannot aspire for. My personal number of what the size of the market would be somewhere between $2 to $5 billion. Yeah, that is very wide range. In terms of, the technology transfer is immediate. Yeah, we are getting started running on the ground immediately. When would products be available for? I wouldn't say we would have to wait 2 years for the first products to become available and 3 years for a full-scale plant to be available.
Okay, so that's on Thermax. We need to take a short break. On the other side, Manisha Gupta will be with us, and she has with her Sachin Jain, who's the India head of the World Gold Council. Stay tuned.
Welcome back, and joining us on the show now is Sachin Jain. He's head of the World Gold Council in India. Sachin, hi. What the last 24 hours have been, the kind of jump up that we've seen in case of the gold prices. They're all-time highs and still holding around those levels as Asia also joins in case of buying. What is your sense of such sharp uptick that we've seen? The global central bank rate cut cycle seems to be beginning now. And where do you see the gold prices headed from here?
First and foremost, Manisha, thanks for getting me on. It's an absolute pleasure always to be on your platform. And as you said rightly, it's been a very sort of exciting, oblique buoyant, oblique crazy sort of times that we're seeing, particularly last 24 hours that you mentioned. And various reasons for that, as we all know, dynamics happening all around the world. But certainly, I think the way we see it is that more dynamics around the corner over the next 24 to 48 hours as well. Perhaps the next weeks of volatility that should be coming in. And hence, we all should approach it with a long-term view and not sort of see it from a one-week perspective, because volatility will move it up and down. That's the sense we get.
As you mentioned, it really is going to be about the global central banks. We have seen ECB react. It's the US Fed next week, Bank of Japan, Bank of England as well. Sachin, while we do understand that there's geopolitics and global central bank and the interest rate cuts that would all support gold prices going forward, but how bullish as World Gold Council are you from here in sense of prices?
See, let me give you a global as well as a perspective from India first, Manisha. So from an Indian perspective, we've seen, last couple of quarters has been very strong. Quarter two, which is April, May and June, where the pricing of gold was all-time high. Even then, the demand of gold just dropped by 5% in volume. And value-wise, we were very, very high up. Now, in July, we had the rate cut of the custom duty, which has really spurred the demand. And initially, there was, of course, a very heated time. Right now, the trading is almost happening at par. The demand for real jewelry is bound to increase. That's the view that we see. And and the biggest flow for ETF over the last very many years we've seen in the last almost 8 to 9 weeks. So, last 8-9 weeks has been pretty good from all fronts in India. So I guess the fundamentals tend to be strong, and there'll be physical demand as we go into the season. So that's the view in India. Now, globally, as you said, all the elements are playing up, which are about the geopolitics, which are about central bank buying. But one element that we see globally, which is getting more and more active, is the interest of the ETF, which is coming back. Now, we saw in the first 2 quarters that ETFs were booking profits and liquidating and sort of in cashing out. We've seen that trend sort of reverse, and they're trying to get back. So we'll see in the next few weeks where things end up on a global front.
Sachin, I know World Gold Council does not talk about prices, but 2,700, 3,000, 3,500 for the next couple of years are the kind of targets that we seem to be hearing in right now. Do you think those kind of levels, I'm assuming World Gold Council is bullish as well. You won't give prices, but you're bullish, right?
So we're bullish, Manisha, but I think we're also very cognizant. So we take the cognizance of what this will impact in terms of real consumption. Because, like in an Indian perspective, large part of consumption still is jewelry. And if the prices skyrocket at that level, there certainly will be a very different kind of consumption. And we'll have to study. I mean, we already are, undertaking some studies to envisage what a consumer would be doing if gold touches a lakh or touches higher than that. But I think a steady growth perhaps will be more healthy than a very buoyant one which goes up and down.
Oh, absolutely. So when we look at investment and when we look at retail jewelry buying within Indian markets, and I remember you telling me that 700 to 800 tons of an import this year is something that you're yet again working with. Have you changed those numbers at all? And number 2 is investment versus jewelry buying. How do you see those numbers stacking up?
Well, actually, let me answer the second question first, Manisha. So in the quarter 2, we saw that the demand for jewelry dropped by 17%. Of course, there were all-time highs of prices of gold. and the demand for investment bars and coins went up by 47% in volume terms and almost 76% in value terms. Now, that is something that we had never seen before, and investment bars and coins saw a lot of strength in quarter two. Now, as we see in quarter three, that continues, and the dip that we saw in demand of gold jewelry, that tends to sort of come back with the festive season starting very soon. So that's the outlay from an Indian point of view. And your perspective of whether we're going to be changing the number. So our view was 700 to 800 tons broadly for the annual consumption. We believe it should be still in the same range, perhaps slightly on the upper side of that range is what we think. But end of quarter three, we'll have the exact outlook for the entire year for you to see.
Oh, well, the higher numbers there. Sachin, as always, thank you so much for joining us and putting all of those numbers in perspective. So, well, yes, still bullish on prices, but yes, a steady pace on the higher side would not hurt the retail and the investment demand, because the kind of volatile moves that we are seeing in gold perhaps could dent that. As of now, we're looking at in the Indian markets a very steep discount working in because of the high prices. Not too many buyers out there. But with that, that's all the time that we have on Halftime Report. Business Lunch will take all the action ahead.